This is More Knowledge, More Wealth with your host, Gabriel Shahin. Gabriel is a certified financial planner and a registered investment advisor at Falcon Wealth Planning. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the services or securities discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. Now here's your host, Gabriel Shahin.
Good day, this is Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. My job is to go over the knowledge you need to increase your wealth. Now, to the listener, you can always reach out to myself or any one of my colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short. And you can visit our Knowledge Center where you can have access to this episode, any one of our previous episodes as well through iHeartRadio, Spotify, or your podcast. And visit our Knowledge Center. That's on YouTube. We have almost 1 million views on that thing. It's been less than a year. We are rocking and rolling on that. So many good, helpful information. If you want to hear a topic that you want me to address so you have it evergreen on YouTube, send it to radio@falconwp.com. That's radio@falconwp.com. Now, I'm the president of Falcon Wealth Planning. We are a fee-only, non-commission, true fiduciary, folks. That means we sell brain at Falcon Wealth. And we handle all topics in regards to personal finance. Anything that involves a dollar sign. It doesn't matter what it is, whether you're thinking about buying a car, electric car, leasing, getting a loan, moving, buying a house, renting a house, investments, taxes, estate planning. Folks, you name it, anything that involves that dollar sign, we can help you with. And that is why we're offering a free financial assessment where we're given 1 to 2 meetings, 1 to 2 hours of our time at no cost, folks. Give us a call. We'll be happy to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. And we have offices all over, multiple locations, and we can help you nationwide. Doesn't matter where you are. We're very good with technology here. But there is so much to talk to you about today. I mean, just listen, this past week was a roller coaster. We're talking about Bitcoin spot ETF coming out. People are wondering, what does that mean? Is it mainstream? Is it something that you should do? It's funny. It's funny because Bitcoin originally was like thought of and quite frankly was used for legal activity. We're talking like bad things. We're talking like drugs, money laundering. We're talking about trafficking of all type of negative things. It was bad. The Silk Road was a website people were using Bitcoin to exchange in. It was just not good. And it's weird because the technology has really evolved into so many different positive things through the blockchain technology. It's funny because you have Jamie Dimon who's talking about negativity with Bitcoin, but they use their own version of that through stable coins on their own. So they use the blockchain technology. It's kind of weird how he's so negative on it, but then JP Morgan obviously is arguing with them by the simple fact they're using that technology for their own banking operation. So it's kind of crazy because they're the largest bank in the country and they have billions of dollars that transact on a daily basis. So it's just kind of funny. And it's funny because everybody looks at Bitcoin as like this negative thing. And it's interesting. Like, I own it, right? I'm not telling you you should, because it's still kind of the wild, wild west. What happens with the approval of a spot Bitcoin ETF, it just gives it more validity. Now it gives it more oversight. The irony is with Bitcoin, people liked it because there was no oversight. It was unregulated. It was decentralized currency. What is Bitcoin? It's a currency, a digital currency. So it's funny now that there is kind of more control in it. But yet again, just the irony in the whole thing is people are like, it's bad. These are for hackers. These are for people who do bad illegal things. And then what happens on Tuesday, January 9th, SEC website gets hacked saying that the ETF, spot Bitcoin ETF, has been approved. It's like, you can't make this up. Like, hackers, how about you shut up because you're validating why they shouldn't approve it. It's just so ridiculous and ironic that that would happen. And SEC, like, getting hacked, like, who's running that thing? I feel like you get hacked, you should be fired. That's just kind of weird in my opinion. But it's just interesting because the roller coaster of cryptocurrency, not just Bitcoin, but Ethereum is also important too. A lot of that technology is used in NFTs, which is non-fungible tokens. These are property essentially that you can create. You've seen it a lot with paintings, electronic versions of paintings or digital art. You can own a piece of that as well. So, but the idea is should you do it, right? Because the stock market did very well last year. Bitcoin did very, very well. And now with an ETF, you are able to have much more liquidity to it. It is more logical to own because you don't have to worry about a digital keychain. You don't have to worry about a passcode. You've heard of people losing hundreds of millions of dollars on a jump drive, or they couldn't remember their password. And you only have maybe 5 tries, 10 tries before it goes away. And you can never access your money. So it does give more validity on that point. But what does this mean for you? I mean, I have clients already that own Bitcoin. They've asked me about it, how to do it. I used to recommend them to Coinbase or Gemini, something like that. But what should you do? Is it necessary? I mean, if you did have $1 million, how much should you do? I don't know. 1% of that is $10,000. I mean, that wouldn't give me heartburn. 5% is $50,000. I mean, that seems a bit excessive. And so there is no right answer. It depends on you. Some people still don't feel the ethical reasons just based on the earlier usage of Bitcoin. Well, now they're saying that cash transactions are up to 5% of illegal activity, and Bitcoin is less than that because you can track the Bitcoin. You can see it on the blockchain. You can see all the transactions through the ledger of who owns it. Even if it's an illegal activity, you can see it, and they would have to use it, and then they could still check it that way. So they still are illegal Bitcoins on the blockchain that the government is literally waiting to move so they can track the person that actually has it. So it's just interesting, folks. And we're coming off of 2023 that was fantastic. I mean, the S&P 500 did 24%. It's huge. Now, granted, last year was pretty crappy, right? If last year lost 20%, and this year made 25%, you're pretty much back at whole. You know what I mean? If you have 100,000, you lost 20%, you're at 80. You make 25%, on 80, you're back at 100. You see that? You lose 20 but make 25. You're not up 5%, folks. You're broke even. So a lot of this is just coming back from the crap of last year. Dow Jones up 16%. NASDAQ up 47%. I mean, don't get me wrong, they pretty much lost 40% last year. So they're still not back to where they were. And by the way, the beginning of 2024 has been rough for pretty much the NASDAQ and the tech companies, the Magnificent Seven, and so on. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth here on every week, and talking about all important topics of personal finance. And I cannot not talk about Bitcoin. And the Bitcoin spot ETF that's available and that's coming out. And so the thought of all this is, because there's 11 ETFs, big name people like BlackRock and so on that are coming out with this, is that what are you doing about it? I'm here just saying that there's going to be volatility wherever it is. Still with Bitcoin, it's unproven. The price movement on that is still not fully understood. So if you were to invest in it, I'm not upset at you anymore. I'm just saying that you have to proceed with caution and be aware that this is a highly speculative investment still. That is a key point to this all. Because when you look at core indices, you don't need, don't get me wrong, I would love 25% annualized returns. Absolutely. But do you need that for your goal? You get what I'm saying? Is it necessary to take that much risk? Because if you're averaging 25% returns, there could be years where you lose 50%. These are the key pieces that people don't look into. These are the key pieces they don't understand. They only see the top of the iceberg. They don't see underneath the iceberg. You see the successful business owners out there. You don't know the times that they were living on their friend's couch, eating top ramen. You only see them today being successful. It's the same thing in the stock market. The people you know with $1, $2, $3 million plus dollars, well, they had to go through last year's 20% plus drop. That's hundreds of thousands of dollars, potentially millions of dollars of drops in their portfolio. You know, it's funny. People say you get rich off individual stock, but you stay rich through diversification. Now, I'm not saying you diversify everything, right? There are some people that are just heavy concentrated in real estate. Well, talk to them, see how they did in 2008 and 9 and 10 when the price of real estate was still dropping and no tenants. And oh, by the way, tenants that they had destroyed the home, not paid, taking a year or two to kick them out, depending on where they live. So the idea here is just straight up diversification. And right now, you have the Magnificent Seven carrying majority of the returns of the market. You can tell by the NASDAQ doing almost a 50% return in 2023. So when those 7 stocks go up, markets do well. When they go down, they do bad because they're so massive. This is why people like the Dow Jones. It's not a market weight portfolio. It's a different weighting system they have. It's a simple weighting. So that's why the Dow Jones is only up 16%. Some say, well, it's more value versus NASDAQ growth. Not completely true. You have companies in there, like Apple and so on, that are big tech. Let's take it a step further. Small cap companies, along with mid cap companies, Russell 2000 and the S&P 400, up roughly 14% each. Also underperform large cap companies. Why? Because of those Magnificent Sevens. See if I can memorize them here. Apple, Amazon, Microsoft, Google, NVIDIA, Tesla. I know I forgot one. Amazon, Apple, Microsoft, Google. But probably, I think I said them all now. I think I should write it down. But the idea here is that those major companies that we all pretty much know are part of that Magnificent Seven. But so the question is historically speaking, mid caps and small caps in particular, because there's been Nobel Prize winning research on this, should be outperforming large companies. So it's interesting that it's not. I'll give you a simple concept, guys. Let's say there's 2 companies, and you can own one of these 2 companies, Starbucks or Peet's Coffee. You can own one of them, just the whole thing. Which one would you own? Well, obviously Starbucks, right? They're a multi-billion-dollar corporation, known worldwide, stable earnings on every corner. Common sense, of course you would own Starbucks. So as an investor, you would buy Starbucks over Peet's Coffee. So we know that. I know that. You know that. Hell, Peet's Coffee knows that. So Peet's Coffee has to do something to entice investors. They have to trade at a discount to entice for higher expected rate of returns for you to invest in a Peet's Coffee. That is called the small cap effect. There is a small cap premium, or small cap companies outperform large cap companies over time. Small cap are smaller companies, large cap are like these big tech. They're bigger companies. So what the heck? It hasn't been doing that. Didn't do that in 2020, didn't do that in 21, 22, 23. Like, when is this going to happen? Heck, up until middle of the year, small cap was pretty much down. They had a roaring, amazing Q4, almost 20% in Q4. So when is it going to happen? Well, let me tell you this. We're going to go on a quick break, and when we come back, I'm going to talk not just more about small cap, mid cap, the valuations and so on, and how you should have a diversified portfolio and take a look at your situation. But I'm also going to talk about international because it's the same story, folks. So we're going to go on a quick break, and if you have any questions on this, you want to reach out to us, we would love to help. We'd love to take a look at what you're doing to make sure you are prepared for what's coming up in an election year, in a year with already so much volatility. Phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Folks, we're going to go on a quick break. We'll be right back.
This is Gabriel Shahin, Certified Financial Planner, your host of More Knowledge, More Wealth. That's on every weekend. We're going over all important topics of personal finance. We're going over retirement planning, making sure you're prepared for retirement, Social Security and strategies, real estate, taxes, avoiding them now and in the future, investments, reducing fees, commissions, and so on, insurance, and estate planning. Folks, we are offering a free financial assessment that you could take advantage of. We have offices all across Southern California, including the Inland Empire. Give us a call to take advantage. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website, falconwealthplanning.com. That's falconwp.com for short. Enjoy the show. We look forward to serving you.
Welcome back, folks. This is Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth, here on every weekend talking about all important topics of personal finance. We are talking about today, we started with a Bitcoin ETF, then we moved over talking about the S&P 500, Dow Jones, NASDAQ, just having such a good year for this year, for last year in 2023, and now looking at what's to come ahead for 2024. I'm just talking about how small caps, so I was talking about how great large caps did. Magnificent Seven were pretty much the main ones that did successful. I was fixating on the simple small cap companies, the smaller companies, Russell 2000, how it did only 14%, and the S&P 400, the mid cap companies did about 14% as well, 14.5%. And so the understanding that when you look at just the valuations of some of these companies, this is why it helps to kind of work with a professional, right? Because you kind of, hopefully you're not doing this, but some people say, oh, look at that 5-star fund, we should buy that. Well, it's 5-star because it already did so well. You know what Warren Buffett calls that? Buying high. Do you like buying high or buying low? I may argue it might be sense to buy a 1-star fund, depending on the situation, assuming they're not buying crap or zombie stocks or whatever the case may be. The second piece to this is the actual price to earnings ratio, just something simple, like are they making money, right, versus what they're trading at. And when you take a look at small and mid-cap companies, they are trading at a substantial discount compared to some of these large companies. Some of these large companies are now typically 20 times earnings is a good example. Why is that? Because it's probably a 5% rate of return, right? 20%. If the price of the stock is at 100, okay, and they're earning about 20, we'll say price of the company at 100, and they're earning about 20, right? 20% of what they're making, that's roughly a 5% return. That's not bad, you know? So that is just the core. Well, you have companies trading infinity, right? Because they're losing money, and they're still trading at, forget the share price, right? $100 a share doesn't matter. $1,000 a share doesn't matter. It's the market capitalization. That's the price of the share multiplied by all the outstanding shares. That's how they get the valuation. That's how Apple's a $3 trillion company. Some of these others that are $2 trillion, $1 trillion, and so on. So that's what matters. So the idea is you have these companies valued at $1 trillion that some of them are not making much money. Why? Because they're all based on what they're expected to make. Historically speaking, growth companies underperform value companies because of the simple logic is not all of them end up doing what they say they're going to do. Not all of them are able to achieve what they say they're going to achieve. Maybe some of it's not their fault. It could be supply chain issues, political issues, changes that happen in the demand where people don't care. What if a competitor comes up? If you say in 5 years from now, I'm going to create a fantastic electric car that's going to drive itself, who cares if we have self-flying cars? Or forget self-flying, even though it's really easy, I'm sure, to do autopilot in the air with sensors and so on, and the radars, but forget that. Wouldn't you rather, who cares about a self-driving to Arizona from Los Angeles for 5 hours when you can fly there for an hour with no traffic? Or how about from LA to a suburb, which normally takes 2 hours, it only takes 20 minutes? Who cares about the electric self-driving car when you have self-flying cars? I'm not saying self-flying cars are coming out or you should invest in it. I'm just talking here. This is why they significantly underperform. My thought here, I'm just trying to figure this out, of why small cap is so underperforming. I think, personally, not telling you to buy it, is that it's a fantastic purchase right now. And for those who have globally diversified portfolios, stay disciplined. This is the core piece. This is when people are getting out of it. This is when I say you should be getting into it. And for you that were buying and holding the Googles and the Apples and the Microsofts and the Amazons of the world, number one, bravo. But maybe this is a good idea to start looking at divesting out of some of these. Heck, you got Google and Amazon looking at antitrust lawsuits on monopolizing and looking about breaking up Google and so on. You have Apple that really, what have they created recently? Like no real innovation at all. They have these headsets that are like $3,500 that nobody has any interest in buying? Like, give me a break. Augmented reality? Like, good luck. Let me know how those sell. Okay? So the idea is when you look at a diversified portfolio, don't get upset at the losers. I would say be happy with the losers because those are on sale. And currently they're on sale. In my opinion, it's a matter of time before those are a big part of your portfolio. And that's why globally diversified portfolio is huge because you don't know what's going to happen. Don't even think you know. Hell, don't even think I know. I'm talking logic here. I'm probably right, by the way. But who cares if I'm right or wrong? I'm not telling you to put all your money in small cap because of what I'm saying. Hell no. I'm saying the opposite of that. I'm saying diversify. And for those who are just heavily invested in big tech because it's done well, be careful. You have to be careful of that because that can hurt you. Look what happened in the dot-com bubble. It kind of feels like that, by the way, except the big seven are making money, right? This Magnificent Seven are the companies that I've listed and named. But still, it still feels like that. These zombie stocks that are getting like this money just thrown to them, they're getting these bonds of billions of dollars. Here's why I hate index funds for bonds. Because when they come out with an issuance of $3 billion, $5 billion, $10 billion, whatever it may be, of companies that are probably going to go out of business, and the banks are forced to refinance them because they don't want to default on them because then they'll never get paid, right? And the benefit is they're going to sell those bonds. You know why they can sell those bonds? Because companies like Vanguard, BlackRock, State Street, the BND, they have to buy those issuance because they own the index. Everything that comes out, whether it's crap or not, they have to buy it. You get what I'm saying? Why would you be subject to buy companies that are probably going to be out of business? Why would you buy those bonds? It makes no sense in the world. I don't understand it. But I understand it from an index point of view, but you're an investor. Like, it doesn't make sense for you to own that crap. But people do it all the time. Oh, I believe in indexes. Hell, I believe in indexes. I'm telling you, Gabriel Shahin, president, CEO, founder, principal, whatever you want to call me, best looking person on the radio. Joke, right? Radio, right? But the idea is, it makes no sense. I just get frustrated with this. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth, here on every weekend, talking about all important topics of personal finance. And today I was just going over the simple concept of diversified portfolios and how certain people are just investing in these indexes blindly, investing in large cap because that's what they think they should do. And they're buying like these Vanguard total stock market indexes or global indexes that are market cap weighted, which, oh, by the way, is 70+% in large cap. 75%, 3/4 of what you have is large cap. That's not much diversification. And then you start looking at international. International. Last year, developed markets did 18%. Not bad, pretty good. They're due for it. Emerging markets still, I understand China and Russia and all this stuff, but still less than 7%, 6%-ish return on that. Like, it's just crazy when you start looking at just the big picture of what's going on in your portfolio. And when you see and you get upset with international, man, the international, they're crazy, they have no control or too much control, or there's too much corruption, or there's just not as much growth, whatever the case, whatever you feel is the reason you shouldn't do it, I'm telling you, and I'm telling you now, that is something that saved people in the dot-com era. International exploded during that time. And America right now, think about this. Our growth rate, a married couple on average has 2.2 kids. Well, that's two people, right? Two. America, right? Two people that create 2.2 kids. It's equal growth. America, our population will not grow. If anything, it would be a declining population. That could even be more true, but the simple fact of so many baby boomers are old. So many people are over 65. 1/3 of our population is over 65 years old. That's a declining population. You know what has helped America? Immigration. And that kind of became like an issue. Now we have illegal immigration, illegal immigrants, illegal aliens, whatever the hell you want to call it, whatever the hell is going on at our borders, south borders. I mean, holy smokes, that's crazy. I'm not talking about that. That's just stupidity. We're talking about people coming over that are PhDs, medical doctors, college graduates, engineers, software engineers, civil engineers, people in finance. There's so much quality people that can come to America that helps our country. Majority of the innovation that we've had, hell, Elon Musk, he's an immigrant. We've had so many people that's helped people, our society, America, our economy, because we are a country that accepts immigrants. The idea here is don't just accept idiots. Don't accept people with fake addresses. Don't accept people of, how do I say this politically correct? Ties to terrorism. It's just frustrating because the portfolios are sometimes reacting close to the news, which is no logic. When you look at how cheap emerging markets is, I wouldn't be shocked. I'm not telling you to buy it. I'm telling you should own it. It should be a piece of your portfolio, not your biggest piece in the portfolio, but there should be some exposure to it. And same with developed markets. Emerging markets, like academically speaking, is the highest expected rate of return asset class that you should be holding and that you would own. Some would argue that with Bitcoin because it started at a penny and now it's worth 40 something $1,000. I get it. I'm just telling you. Diversification is key. And folks, if you need help with this, what I'm talking, it's like, oh my gosh, well, I always did indexing because Gabriel said that before. Now he's saying the bonds, they're owning crap, which they are owning crap. They have to own everything. Keep that in mind. Give us a call. This is why we're offering a free financial assessment, 1 to 2 meetings, 1 to 2 hours of our time at no cost, folks. We can help. Our phone number is 855-963-2526. That's 855-96 Falcon, like the bird, or visit our website at falconwealthplanning.com. That's falconwp.com for short. And you can get this episode, any one of our previous episodes, go to our Knowledge Center. That's such a fantastic thing. You see something you like, share the hell out of it. It's so important. And it's things that people don't like talking about. People don't want to talk about that. Some of these are like the hidden secrets of our industry to help you. And that is what brought success to our company. It's having podcasts like this, radio shows like this, going on media circuits, and just telling you what you should be doing. Because a lot of people say, hey, I got all these ways I can help you, but you have to pay us first before we can help you. No, I don't believe that. I believe, how about this? How about I selflessly help you? Will selfishly benefit me later. Because you're like, look at how competent these people are. Look at how honest they are. They truly just want to help. If you're just a good person, good things will come your way, right? If you're a good person, you probably have friends that are good people. If you're a jerk, you probably have friends that are jerks. So anyway, I could talk all day, folks. I want to limit me for 30 minutes here. But folks, I want to thank you for tuning in with me. You can always reach out to myself or any one of my colleagues at Falcon Wealth Planning at 855-963-2526. That's 855-96 Falcon, like the bird, or visit our website at falconwealthplanning.com. That's falconwp.com for short. We can get this episode, any one of our previous episodes on iHeartRadio, podcast, or Spotify. And go visit our Knowledge Center on our website as well. That's fantastic. I was just talking about that earlier. So many great videos there with tens of thousands of views on each one for a majority of them. And folks, join us every single week, and we talk about all important topics. And if you want us to read off your topic, please send it to radio@falconwp.com. That's radio@falconwp.com for short. Folks, have a fantastic week. Have a great long weekend. Happy MLK Day, and God bless.